All right, here we go. Stocks by the numbers. Welcome back. Of course, I did a 25-minute video and the mic wasn't picking up my voice the entire time. So, we're going to run through this again. But honest, I'll wrap up the conclusion real quick for everybody. In my opinion, I do still like it. I understand there were some potential negatives that Wall Street could be highlighting and kind of feeding into the sell-off story. In my opinion, conservative personal price target, $9 a share, just my opinion. So let's get into what they reported and what's going on. So stock closed 568, was up 2% going into the earnings. As you can see, down about half a point, 9.5% after hours. Was obviously down much more here at around 480. And you can see we kind of bounced up. Got some light volume right now though. In my opinion, I think the main thing that Wall Street... Well, I don't even know if I can really blame... Well, all right. Here's my logic right now. Here's my thinking. This company technically looks pretty good in the numbers, in my opinion. That's why I spoke highly about it a few times in the past. I know we were talking about like these downward channels and we were popping up. We did a video here. We pointed out the wedge. The stock came down. Look at this to like 250, 240. Boom. We started to break up and out. Again, we have our little consolidation zone. Boom. We started to break up and out. And of course, last quarter's earnings was a pretty nice beat on the top and bottom line. And that had the stock break out, as you see, 897. So technically, we're kind of still in this upward channel now. We could pull back, I want to say, to maybe the 460, 450 range, believe it or not. In my opinion, that really should be the low of the low, and then the stock should bounce from there, because I know people might be concerned that, well, they make their products, overseas, and they mention the tariffs in the 10Qs and the 10Ks when they lay out their guidance for fiscal year 25. So, they understand what's coming, what's happening, but at the same time, they are able to maintain their market share and generate enough revenue to come in above estimates. So that's why you might see money kind of flowing out and going into more American brand name stocks, companies that are doing manufacturing here domestically, right? So that they don't have to pay these tariffs. But in my opinion, it's not an issue until it's an issue. Right? And my basic train of thought is, yeah, they might, bring it down now. They might continue to beat it up over the next week or two. People might look for better opportunities. But, even if we stay flat, we fast forward to next quarter, if they still come in with a decent amount of revenue and they're beating earnings, then you have to buy the growers. That's the way I look at it. So that's why I'm saying, in my opinion, this can easily get back up to 9. But even if it comes down here into the 4s and it kind of like hangs out a little bit and then you have like a run up, you could still get back to like the 7, 8 range, in my opinion. And it really should happen before earnings, and I'll explain myself. So estimate, we were looking for a loss of about 1 cent a share. That's kind of what the company posted. Revenue came in just around that $100 million milestone mark. 99.84. Revenue estimate 96.55. So they beat by about 3.25%. 3.25 million, 3.4%. But again, stock down after hours. But you can see they lay out revenue up about 11% year over year, gross margin 39%. And you can see for the full year, they hit 378 million with a reduced net loss of 6 million. So we're very close to hopping the fence and having consistent positive income. We are very close. So now, if we're at 99, 100 mil, and we can kind of stay in that range, maybe plus or minus like 2-3 mil quarter over quarter now, then I'm looking for right around 400 million for the next year. And that should be slightly enough to put them possibly in the black by 6 million, 10 million. You understand what I'm saying? And then once we see them hop the fence to profitability, just like we saw, again, I always mention Palantir had the premature breakout of that long-term wedge. Company came out. Oh, yeah, by the way, all of a sudden, we're net income positive. We're EPS positive. Boom. That's what drove the stock up and caused it to pop up and out, right? So that's why I'm saying that even if it stays down or it stays quiet, when that announcement comes, you're going to probably see it, in my eyes, break up and start chunking up to these previous levels that I may have laid out in the last video. But you can see, looking at about 905, and that's basically right where the stock went, tried to retest it, and then we started to drop again into our tight consolidation zone. And now again, after this earnings report, we happen to break down instead of break up, as we've been doing. But in my opinion, I really do think it should be short-lived. And let's get into these numbers here. So revenue, $378.3 million, marking 9.9% increase from the previous year. Very nice. Driven increase in retail customer revenue. Yep. Gross profit rose to $144.7 million, a 43.9% increase, attributed to cost saving in transportation, fulfillment, and product cost. Sales volume growth, price increases. Okay. Company reported operating loss of $6.3 million, significant improvement from the $38.9 million loss in the previous year. Do you see the trends of these numbers? Better cost management, increased gross profit. Net loss improved to a loss of $6.1 million. It was $39.2 million in the previous year. Net loss, 6 cents, an improvement, 42 cents. Very nice. Company saw increased retail customer revenue, $22.6 million increase in wipes revenue, $18.8 million increase in baby apparel revenue, $6.2 million increase in baby personal care revenue. However, there was a decline in adult facial care revenue by roughly $4.5 million. And of course, you can see, the increases in the other segments, obviously, outweigh the slight decrease they saw here in this segment. But I will say that's really not the company's forte, if you think about it, right? We know they're more about the wipes and the baby care products and the baby clothes and whatnot, right? That's mainly what they're bringing to the table. The fact that they had this other segment, I mean, of course, is nice, still bringing in a couple of bucks here and there. But in my opinion, if you're specifically looking for that segment, adult facial care, as we know, we've seen other stocks like Hims and Hers, right, just growing phenomenally. So I don't know about you. I know there's a bunch of companies out there, of course, but when I think something like that, like adult facial care, like we've seen the growth in something like Hims and Hers. I wouldn't necessarily think of Honest like that. But as we say, it's always nice to have, a diverse product line. You never know when people might say, oh, you know what, that sucks. That one sucks. I'm going to try this one from Honest, right? And then all of a sudden you have like those cyclical sales come in. So not necessarily a bad thing. And again, the increases outweigh that drop. So I don't view it as a red flag. Direct-to-consumer revenue declined. $6.6 million decrease in diaper revenue, $1.7 million decrease in adult facial care revenue. Okay. The company continues to focus on product innovation, leveraging in-house research development team, cleanly formulated products based on the latest green technology. Okay. That'll obviously continue to keep them in a positive light, just as long as the like the green development of the products or the green packaging they use, just as long as that doesn't seriously increase in value, in cost, you know what I'm saying, so that it doesn't eat away into the profits. Company plans to gradually transition away from Honest.com as a shipping and fulfillment channel beyond 25, while ensuring the site remains a resource for educating consumers and showcasing the complete product portfolio. Okay. Transformation initiative focusing on brand maximization, margin enhancement, operating discipline, existing low margin business in Europe and Asia. Oh, I'm sorry, exiting. Excuse me. Exiting low margin businesses in Europe and Asia, optimizing contract manufacturing strategies. So again, they address the fact that they have the tariffs, in the front of their mind. But right now, I don't see it being an issue until it potentially becomes an issue. And also, again, they're looking to maximize the margins coming out of North America. And as you see, they're looking to exit Europe and Asia. The company took measures, bolster key aspects of its supply chain, ensuring sufficient inventory, minimizing lead times for raw materials, support continued growth, manage cost pressures. Company exited business in Europe, focused on North America, aligning with its strategy to enhance margins and operational efficiency. Honest Community donated over 36 million personal care products and essentials to those in need since 2012. All right, awesome. 2024 donated more than 700,000 to support maternal and infant health programs. All right, very nice of them. Company offers a competitive compensation benefits program, including Honest University. Oh, excuse me. Company committed to environmental mindfulness. Yes, we know that. Very nice. We're reading. Yep, Europe, Asia. Company maintained a strong cash position with $75.4 million in cash as of the end of the year. It has a $35 million, this is what I wanted to show you guys, $35 million revolving credit facility with JP Morgan Chase Bank, which remains undrawn, providing additional liquidity. So we essentially have no debt, and we have about $110 million that we have on hand. Company also raised $41.6 million through stock option exercises, 21 employees. Okay. No dividends were declared or paid, and the company does not anticipate paying dividends in the foreseeable future due to restrictions in the 2023 credit facility. Well, whether the restrictions are there pertaining to the credit facility or not, basically, you know, it's simple math, right? It's simple business. And the problem is, as you're growing, you want to, of course, you shouldn't really take on debt while in the red to make shareholders happy or put their minds at ease and start to prematurely pay out a dividend, in my opinion. That's not really the way you see these companies do it, if you take notice. They, continue to grow, make a name for themselves, obviously, continue to sign contracts, new clients over the years. The revenue steadily chunks in. The company goes from the red to the black. They maintain and grow that business model for some time. Because what you want is, you want an emergency cushion almost. Just like you all probably have like an emergency, bank fund in case, whatever, you get a flat tire, you need a new refrigerator, right? You have $1,000, $2,000 on hand so you can take care of something in case of an emergency. And these companies, you have to make a cushion for yourself, right? Because what if all of a sudden there's an issue? Who knows? There can be an issue with your supply chains, your logistics. Maybe someone said something stupid. Now everyone's boycotting your product, right? So you're going to have to deal with any negatives, even potentially dropping back to operating at flatness or operating at a loss for 1, 2, 4 quarters. And you're still going to need enough liquidity to not only take care of those existing expenses, but also be able to maintain that dividend, right? Because the last thing you want to do is announce a dividend and then take it back, or start cutting it because all of a sudden your business sucks, right? So, I appreciate the fact they mentioned, the restrictions with the credit facility, but in general, if we do see over the next couple of years this business consistently growing, all of a sudden we're at 600, 700 million in change for the year, the company's in the black by, 90, 100 something million, you may hear about a micro dividend potentially coming. Because even if they deal with some issues, it'll be enough for them to maintain with their existing with their existing blackness on the sheets, if you will. That's great. Future outlook, honest company, focusing, transformative, enhanced margins, and we break down all the challenges, okay? I just want to see real quick if we're missing any numbers. Record quarterly revenue, 100 million. And it's a phenomenal sign. I think we may have spoken about that in some previous updates as well. We were saying that they were consistently growing, right? They were at the 70s, now the 80, boom. Now we were at like 91, 93. We saw last quarter, estimates were like 93. They posted like 99 or something, right? So we were speaking about getting above that mark and potentially hopping the fence, going from the red to the black. So in my opinion, again, I know it's down right here in the short term, but as we say, sometimes you have to deal with the short-term volatility to ensure that long-term growth, right? And that's why, again, with the tariffs, I understand if you all might say, listen, the company's doing great, but I just think there's better opportunities right now. That's fully understandable, right? No one can really debate with you too much on that. But I will say that the tariffs, again, it's not an issue until it's an issue. If we see now that with tariffs being implemented, if we see over the next 1-2 quarters, all of a sudden, revenue is down, profitability's, seriously missing the mark by 15-20% of estimates because tariffs ate into the profits. You understand what I'm saying? Then we can say, all right, this company's going to struggle for at least the next 12-18 months. Let's take the money and run and put it somewhere else and, come back to this in a year or two and we'll see where it stands, right? So you kind of have to play it by year, but it's not an issue until it's an issue. That's my point, really, in my opinion. Personal price target, $9. Conservative. Gross margin expanded 530 basis points to 39%. Company reported a net loss of less than $1 million compared to net income of $1 million in the prior year. Okay, so that, that could be the one reason why they're beating it up right now. To drop the stock down that much over what, $1.5 million going the other way. In my opinion, they're missing the big picture, right? But we understand how a lot of institutions and fund managers on Wall Street think, if you don't only see positives, they may feel it's just not worth holding. And they may start to scale out and they may look for other opportunities, right? So, it is what it is. But overall, the big picture, the company still looks to be growing, in my opinion. Adjusted EBITDA improved to $9 million, up by $4 million from the previous year. That's a good jump. For full year 24, revenue increased 10% to $378 million. Gross margin 38%. Net loss improved significantly to $6 million, a $33 million improvement from previous year, right? So that's what I mean. We continue the trend. We give them one more year. Boom. We just went from a slight loss to slight profits. Adjusted EBITDA was positive at $26 million, marking the company's first full year of positive adjusted EBITDA as a public company, right? So is every metric up and away? No, of course not. But again, speak to any business owner in the comments section. They're going to tell you it's never the case where you're on a long straight highway and you're in your car with your business and you're just going, there's no traffic, there's no potholes, right? You're never going to have that clear straight path, that beeline, so to speak. Company ended the year cash balance $75 million and no debt. Where's, what's his name? Ramsey, right? Where's that guy? Dave Ramsey. Let him know. Hey, we're looking at this company. They got cash on hand. They're growing. They got no debt. What do you think about that? Bet you he'd say buy it, right? And that guy's on TV. But then again, so is Jim Cramer. So I don't know what that really says. The revenue growth driven strong performance. Baby apparel. Yep. Tracked channel consumption for the company grew by 7%, outperforming the comparative categories, which were down by 2%. All right. Consumption for the company, the largest digital customer, increased by 35%. Operating expenses increased by $11 million to $40 million in the fourth quarter. Higher general administrative expenses, retail marketing expense. Yep, it takes money to make money. For the full year, operating expenses increased by $12 million or 8%, reflecting a decrease of approximately 60 basis points as a percentage of revenue. So less of their revenue was spent on the operating expenses. You understand? A smaller percentage. Now, it was a small drop, but again, a lot of these fundamentals are moving in the right direction. So that's why looking at the market cap, looking at the way the business is growing, what the numbers currently are, I feel like it'd be hard for someone to say, oh, this is a $3 stock. You know what I'm saying? More than likely, even if people aren't bullish on it, they would say, oh yeah, it'll remain flat, it'll hold steady, and it'll hang out at $5, $6. Right? If you're bullish, obviously 9, 10, 12 a share. Okay, CEO quote, our Q4 and full year 24 financial results demonstrate that our strategy is working. We achieved record results ahead of our outlook, with revenue growth of 10% and first full year positive adjusted EBITDA as a public company. We also achieved gross margin of 38% and expansion of 900 basis points compared to last year. Yep, cleanly formulated, maintain the honest standard. Apparently that's must be highly spoken about at the great Honest University. For its full fiscal year 25, Honest expects revenue growth in line with its long-term financial algorithm of 4 to 6% and adjusted EBITDA in the range of 27 to 30 million. The company's financial outlook includes considerations for tariffs related to product sourcing in China and Mexico. So taking that into account, they're still forecasting growth, steady fundamentals. So that's why, again, it drops in the short term because people might be emotional or people might be focusing on the tariffs. I can appreciate where they're coming from. You can't completely dismiss that viewpoint. But again, on the flip side, I think if you really look at the numbers, the overall business, the growth is there. And again, even if we might not see, 30, 40% increases across the board year over year, slow and steady wins the race, right? And if you compound year over year, if we take a hypothetical business and we compound its growth 6%, 8% year over year in perpetuity, you and I both know what's going to happen to the overall value of the business and, where the underlying stock would trend towards. Is this the same article? I don't even remember. Yeah, excuse me. I love that. I love that cash. I love that no debt. I love that they have the 35 million from Chase that they haven't touched. Look, you can see it was about 90 million this time last year. Boom, we just about hit 100 million gross margin, 33.5%. Now we're up 39% almost. But the operating expenses, you can see, jumped up basically just as much. Right? So that's why, a lot of the businesses, as we know, it's a variable business model, but also it's essentially all about volume. It's really a volume business model, right? So that's why I say, as long as they can continue to do what they do, the volume, in theory, will outpace expenses. The revenue generated will dwarf losses. We're going to get it to the black. It's going to grow. Again, that's not guaranteed. That's just my opinion. In theory, the way the business is trending. We're reading. Yeah, we know all this, though. Get me back to, adjusted EBITDA, looking for 27 to 30 million. I wanted to show our liabilities, our equity. Yeah, you can see a jump up in marketing expenses as well. Was about 7.8 mil. Now it's up to 11.3. Right? This is what we know, though. We know you have to spend money to make money. R&D, slight bump, 1.5 up to 1.7. Where are we? Here we go. Okay. Cash, look, you can see this time last year, about 32 million, 32.8. Now we're at 75. Essentially doubled cash on hand year over year. Accounts receivable slightly up. Inventory's up. Total current assets, look at that. Was 157 million. Now we're up to about 214 million. Absolutely phenomenal. Total assets across the board was about 201 million. Now we're up to about $250 million. 25% increase year over year. Accrued expenses up. Total liabilities down slightly. 78.4 million down to about 73 million now. And as we know, assets minus liabilities yields equity. And we can see the equity right now sitting at about 174.3 million. This time last year was in the low 120 million range. So that's 40% year over year. So that's why you can kind of see the writing on the wall over the longer term. The real question is, do you want to remain patient? Do you want to deal with the volatility? Right? It closed today 568. What if it goes to 468? Oh, excuse me. What if it goes to 468? What if markets begin really chunking down and correcting because the dollar starts to strengthen? Now the stock's down to 368, right? The question is, can you stomach it? Can you keep your eye on the prize? Can you continue dealing with the nonsensical bullshit in the moment to quote unquote know what the outcome will be over the long term? Again, nothing is guaranteed. But we look back at a lot of the other smaller, cheaper stocks that we were watching, like Soundhound, like Fubo, right? And go back, think in the moment. Oh, yeah, a lot of people thinking, commenting on videos, asking each other, why is it down? How come it's not moving? Is there something wrong, right? And now you see where we are today, and you want to look back. What do you want to do? You want to kick yourself in the head and say, hey, don't worry about any of that. Just, if you think it's a winner, accumulate shares, build a position, right? That's what I always say. Total liability, shareholder equity, you can see again, up about 50 mil year over year. Just fantastic in my opinion. I think it's growing very nicely. Very, very nicely. But yeah, I just wanted to show the equity and whatnot. So now if we reevaluate our company very quickly, we can see, yeah, we did 378, loss of about 6 mil, so we can say about 370 mil. If we want to value it based on future earnings, we could potentially put that value at about 400 million. If they bring in about that much, right, with a slight profit, could put that value at about 400 million for next year. The equity we just looked was, about $250 million? No, wait, hold on. I confused myself. I apologize. Not that one. I confused myself. And for that, I apologize. Yep. Okay. Liability 70. Equity 174 mil. So 174 million plus, you know what? Let's say 370. Now you're at 540. Right? Company has no debt, 75 million in cash. So you add that. Now you're at roughly 615 million, quote unquote, fair value of this business moving forward into fiscal year 25. Current market cap, 573.5 million as of close with a 6% drop. So now we're at like 530, 535, 540, I don't know, right? So we're at roughly 500 million market cap. Our quote-unquote fair value is around 700 million plus a 1.5 times multiplier on fair value would bring us to about $1 billion market cap, which as you see would essentially double the value, which would generate us about 10 and a half. What do you know? My second level personal resistance price target, whatever the heck you want to call it, my second line, 1048. Would you look at that? So that's why looking at the numbers overall, in my opinion, if it wants to drop down, whatever, let it. I think it's going to $9-10. That's why I say $9 is really conservative if you think about it. And even scooping up shares here, if it continues to consolidate and stay down in this channel over the longer term, you accumulate shares down here in the 5s and like the mid 4s. Getting it back to 6.5, 7 even should be a layup, right? I'm sure a lot of us can agree with that. So that's why even if this might not be one that you're looking for, you might have an opportunity here, in my opinion. And that's why I like doing my channel the way I do it. RSI on the daily, technically on the close, we're sitting here at 39 1/3. See that long-term, just descending channel we were in. And of course, if we got a great beat across the board, the stock would have exploded to $8, in my opinion. But again, they decided to bring it down. You can see support level here at about 491. So in my opinion, that's going to be a key level for you to watch. This is on the daily. And you can see the 200-day moving average is going to be just about below that. It's coming up. It's right there. So that's why you could see a drop too, like 465, flash crash 460, 450, right? And then maybe it'll find its footing and start to bounce. But in my opinion, I really don't find any of this an issue. MACD recently crossed to the downside. We've been dropping the last couple of days, but we know that the market saw some red, so we had a lot of stocks chunk down. A lot of short sellers hit them. Look at that. Look at that tight little channel. But you see this is like a trend on the stock, right? Which again, I say that whether you're really looking at fundamentals or technicals, you could probably make more of a bullish case than a bearish case here. And you can see that almost about this time last year, this one started the beginning excuse me, this sell-off started the end of 24. This sell-off started the beginning of 24. But you can see, look at that, long drop, right? Probably the whole time people are like, I don't understand. Aren't the numbers good? How come the stock's not? Right? When you least expect it, when they take it out of the radar, when they make it quiet, they want you to forget about it. They want you to get impatient with it. They want you to, oh man, did you see what this other person posted? They made 2,800% today. You know what? Screw this. I'm selling my Honest and I'm going to buy blah, blah, blah. It's exactly what they want you to do. But you can see these deep descending channels, and then boom, we spike back up. And then we descend, we consolidate, and then boom, we spike back up. This was a really good earnings report. Boom, we spiked it up. Then we drop it again into a channel, and then boom, we spike it up. You understand? So really, no matter how you look at this, you could make the argument for a pretty bull case. But I did just want to show you here as well, on the weekly, you can see the 50-day moving average, 452, right? Might slowly inch up if the stock stays around 5, 455, maybe around 458, 460, right? So that's why I'm saying you could see a pullback, 4.5 to 460. In my opinion, though, as I say, if I liked it at 560, I'm going to like it even more at 460. RSI on the weekly, middle of the road, 50. We're hanging out. We're in our consolidation channel. But again, just looking out over the longer term, looking at how they're growing, again, the current valuation, about $500 million, could make the argument, you know, the market cap could easily be hanging out at 700-800 million, if not $1 billion plus at the rate we're valuing companies nowadays. That's why, again, you know, some people may speak of some negatives. Some people may say they feel there's better opportunities, and I completely appreciate that. Yeah, I can't really debate you too much with that. But, you know, we are stocks by the numbers. And in the numbers, in my opinion, this company is significantly undervalued. And that's pretty much it. I'll end it there. So once again, this is Stocks by the Numbers. I want to thank you for stopping by. If you have any questions, comments, or concerns, please drop it down in the comments section. I'm usually pretty quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, and they are very uncertain. So I do want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for your time. Have a good day.